trading. The spotlight next is on the banking space. The Bank Nifty is right now down about 0.25%. Now, several things that we're tying in together with this discussion. First and foremost, the RBI governor's statement that came through. Mr. Malhotra, in his comments to CNBC TV 18 in the interview that you heard earlier this week, said that not allowing foreign banks to own 26% stake in Indian banks, quote unquote, defies logic. We'll try and actually play that soundbite out. It's a very strong statement coming in from the RBI governor himself. So that's one development. The other piece is that our colleagues in New Delhi are picking up that there seems to be a view forming in the government that perhaps it's time to consider further consolidation of PSU banks and maybe even allow raising the 20% foreign investment cap on PSU banks. So basically turbocharge state-run banks from here on. Now, what could this mean for the banking landscape? And of course, for investors, how should they be looking at the banking sector? To talk about this, we have with us Abizer Diwanji, founder of NeoStrat Advisors, and Mr. Dinesh Khara, former chairman of State Bank of India. Gentlemen, thank you so much for joining in. And let me actually start with the latter part. I mean, this whole idea that do we really need to turbocharge now PSU banks? Mr. Khara, of course, and the market really acknowledges it. We've been having these conversations with the analysts since the morning, and everyone is acknowledging that PSU banks are now really almost giving the private guys a run for their money. The growth numbers are looking good. For SBI this year, the street estimates growth of 12-13%. And there's this big fundraising exercise, a QIP that's happening. How would you describe the PSU banking landscape? Should it just continue as is because things seem to be going fine? Or is this the time to actually look at bigger changes like consolidation?
Well, when it comes to PSU banks, of late, there is a remarkable change in the way they are being managed. And also, they have got a natural advantage in terms of their network. So I think considering the fact that there's an adequate appreciation for the risk management, considering the fact that they have got the ability to raise money from as far as deposits are concerned, they are very well capitalized. So I think these are some of the positives which have to be seen. And also, the other important aspect is that they have been performing consistently well. So it actually means that there is some kind of a strategical change in the way these banks are being managed. So I think this has to be kept in mind. And also, I think last quarter, we have seen that when it comes to the quality of the balance sheet also, the public sector banks' balance sheet looks much better as compared to the private sector banks. So, if at all you put all this together, then certainly this is one segment of the banking sector which the country should be proud of. And also, I'm sure the investors also have also taken benefit of the money which they invested into these banks.
But the question is that whether this is the time to look at consolidation or not, because some of the smaller PSU banks, they've also been doing a great job of, managing and pushing growth. I mean, case in point would be, let's say, a Bank of Maharashtra. I mean, the other day I was reading a report, an analyst report, someone pointing out that they are as aggressive as any, private sector name, if not more. And growth rates have been absolutely blazing. So therefore, the question, let me bring in Abizer as well. Abizer, PSU banks are doing great. The credit cycle seems to be, in the banking sector's favor. Is this the time for bigger tectonic reforms and changes?
Well, I think we have been through a bunch of changes when there was a PSU bank consolidation that happened over time. And I think that is bearing fruit now because we have some size now from what we had earlier. I think that size is still suboptimal, and there is still scope for actually increasing that size. And there is still scope for further consolidation. I don't think, we need so many PSU banks or even private sector banks sometimes. We need larger ones. We need more, but we need larger ones. Now, if there is more consolidation, that will always give them more strength. Now, I would say that the PSU banks have started it with the wave of consolidation that we did earlier. Now there is the next wave of consolidation, people who are left out of it. Say a Bank of Maharashtra, as you rightly said. If it's that aggressive a bank, if it is bolted onto another bank which has size and deposits, as Mr. Khara said, then that bank with the management bandwidth and the momentum that it has already gained could do much better if there is a level of consolidation. But consolidation does bring about a sense of pause because there is integration timeline, which is 8 months to 24 months, which happens. And at this point in time, I think with credit running away the way it is, and especially rural credit, retail credit running away the way it is, we will need to focus on more banks which can do corporate credit, project finance credit. And we will need to move the pendulum back to that from retail because the balance sheets have stabilized. The capitalization is good. Further capitalization can happen as long as it's in the right direction. In my view, that direction should be more of project finance and corporate lending.
Abizer, why? I mean, I'm just going back to the statement you made that we don't need so many banks. We actually need bigger and larger banks. Why do you say that? When smaller banks are being able to push growth, they're nimble-footed, at least some of them seem to be really making a mark. Why do we need bigger banks? Would that not be an impediment? Because, you know, how do you move a big elephant?
No. So, firstly, smaller banks are more vulnerable. And we are seeing that in the private sector. So in the private sector, you see what has happened to a Yes Bank or see what has happened to other small mid-sized banks. I wouldn't want to name them. But any shock that hits their system gets them reeling down. Now, banking is a trust business. And in a trust business, unless you have scale, your ability to manage short-term shocks is not there. So scale is required. So Bank of Maharashtra, for example, tomorrow, if it had one shock, it would come down reeling. And it's a great bank and it should do well. So ideally, consolidation is required to bring it the scale to be able to absorb shocks and the trust organization to remain intact. So that is the reason for consolidation, not that they're doing well.
Okay, so perhaps we do need to look at consolidation and maybe this is a good time. Got that. Now, gentlemen, let's move to the other part of the conversation. That's foreign ownership. Always a very tricky and sometimes a very controversial topic in India, right? But the RBI governor, I mean, made a telling statement that he doesn't see, why there needs to be this 26% cap. Mr. Khara, your thoughts?
Well, I think when it comes to, as of now, the current 26% caps comes from the Banking Regulation Act. And also the fact remains with the 26% voting rights, any resolution can be blocked. So this is what it is. But yes, of course, by talking about this, we have to be very mindful of the fact that if at all we intend to attract the foreign banks to invest into India as a strategic investor, we do experience some challenge. And that challenge essentially comes when it comes to the foreign banks have got a very clear perspective. They would like to invest and also show in their holdco balance sheet also. If at all they don't get the commensurate right of voting, then they have got a challenge, which actually means that we will restrict their investment to 26% only, because voting right, there's a challenge. So that is something which is there. But now, of course, we have to debate whether how much of the foreign banks investment we need in the country. And of course, when it comes to India as a potential investment, there is a lot of interest from the foreign banks, particularly because of the growing size, because of the growing economy. And also, since now we have become the fifth largest, going to be fourth largest. And also we will have a situation where we'll be among the top few economies in the globe. So naturally, all the foreign banks are looking at opportunities, how they can either scale up their presence or they can invest into some such entities through which they can have significant and decent presence in the country. So I think if at all we will look at it in that context, there's a challenge with this 26% voting right, CD.
And all this happening against a backdrop of SMBC, the Japanese giant, looking to buy a stake in Yes Bank. And I think the last reports that we have are that they're looking for an additional 4.9% stake. They want to have at least 25% stake in the bank. Abizer, what would your thoughts be? I mean, again, beyond 26% ownership by a foreign bank, has the time come? Because you made that strong argument for why we need bigger, larger and stronger banks.
So I personally think that with India becoming now a very large major economy, I think this distinction between foreign banks and domestic banks is kind of unnecessary. As long as Indian corporates and Indian consumers are served with meaningfully large banks. Now let me come to the larger issue. I think the 26% voting cap is generic. It is not meant for foreign banks. It is everybody has this cap, and that is enshrined in the Banking Regulation Act, which I think is due for an amendment. Now coming to foreign banks itself, the restriction is, first of all, is ICICI Bank a foreign bank? It is 74% owned by foreigners. It is. HDFC Bank is it a foreign bank? It is more than 51% owned by foreigners. So these are banks which are owned by foreigners. Now the issue is strategic ownership by foreign banks. Now in that case, RBI has a regulation called wholly owned subsidiaries, which basically says that you can incorporate a wholly owned subsidiary in India, which retains capital in India, shields that capital from global vagaries. And that was the intent. However, and this, by the way, this regulation also allows a wholly owned subsidiary to actually undertake M&A activity and buy local banks. And normally that is not there in the law today, and the amendment that, in my opinion, is required is whether these wholly owned subsidiaries, who then become partly owned subsidiaries by acquiring domestic banks, do they have a 51% or more voting right? Because inherently, they still remain subsidiaries of foreign banks. So a new category emerges where foreign banks are allowed to own subsidiaries in India. And that subsidiary, by virtue of being a subsidiary, needs to have control. Now, RBI has really laid out a principle which says that you will remain a subsidiary as long as you hold more than 51%. And if you are not 100% owned, then you cannot, you have to own between 51 and 74%. That's what it is. And frankly, that needs to be enumerated more in terms of giving voting rights, which is commensurate with the shareholding. Because then that is the true nature of a subsidiary. And what we need is maybe another category now of partly owned subsidiaries instead of wholly owned subsidiaries, which provide good capital, captive capital into India, which and banking sector in India will lack capital if it has to be sizes of scale. I mean, even a State Bank of India, which is really large, is not among the larger banks in the world. How do we make sure when India becomes the fourth largest economy, how do we make sure that we have among the top 5 or top 10 banks? We will need capital. Corporates are not allowed to put in capital. Instead, retail capital is what we aim for, and that is never going to be enough. So in my view, foreign capital ownership owned by foreign banks who set up subsidiaries and captive capital in India need to be enhanced. And for that, the voting cap needs to go so that they have voting rights commensurate to the capital they hold.
Very, very comprehensive explanation, Abizer. Really great to hear that. Prashant here, just one last brief question. We're already sort of running out of time. Mr. Khara, it was great to, by the way, see you yesterday evening at the CNBC TV 18 Prime event. Just one thing, and this goes directly to what we are picking up from a lot of bankers we speak to. And bankers tell us that when they go for sessions with the RBI, when the RBI invites them to ask for feedback, etc., I mean, it's very, very clear that, they want to really push growth, focus on growth in a big way. I mean, the question is, what do you need, right? And they're willing to sort of give old sort of legacy rules, limits, etc., relook. In your opinion, Mr. Khara, 30 seconds, if you can lay out, what will, get this to jumpstart this credit cycle? What are the 1 or 2 measures which are the maximum bang for the buck?
I think as far as RBI and the banking system is concerned, they are very well geared up to really support the growth. But now I think that when it comes to demand from the corporates, we need to really get to see that. And I would also mention that when it comes to infrastructure kind of projects, there is enough demand which we get to see. And there's a lending also happening. But when it comes to the larger, broader ecosystem in terms of the corporates are concerned, they're probably now saddled with a lot of liquidity in their balance sheet. They have also raised money through various other alternate sources like equity and also the bond instruments.
Sure.
So that is supporting their growth initiatives.
Fair enough. So the demand, supply is there, demand needs to happen. Abizer, you agree, or you have anything to add on this point?
No, absolutely agree. I think corporate demand needs to pick up. And the banks are ready to lend, in my opinion.
Okay, got it. Well, the stage is set, both of you are telling us. Mr. Khara and Abizer, great to have both of you here, gentlemen. Appreciate your time on CNBC TV 18. Really great conversation as always.